Tariff turmoil and whether it's still going to hit the economy and the stock market or not. Let's ask Tom Lee. He's Fundstrat's chief investment officer and head of research. He's here with us at Post 9. In the market, good to see you, by the way.
Great to see you.
The market clearly doesn't think that tariff turmoil is going to hit the economy and stocks. Is that the right way to think about it?
Well, I think the economy, we've had enough data to know that the tariffs aren't necessarily hurting the consumer wallet or hurting jobs growth yet, but we're just waiting for, as Fed Chair Powell says, to see how it shows up in inflation. So I think the next two inflation reports are going to be closely watched, because if we don't see a meaningful pickup in core inflation and consumer inflation expectations don't move up, then it's going to give the Fed a lot more comfort about cutting over the next 12 months, and that would be good for stocks.
The president continues to talk tough as it relates to tariffs and his trade war. The market, I think, is continuing to reflect a I don't necessarily believe you mentality, that the tariffs are, in fact, going to end up on August 1st, as bad as they sound today or may sound in the days leading up to August 1st. Is that how you think the market is taking it right now?
Well, I think the market's somewhat pragmatic, and they realize the president is making statements to try to force negotiations to come to a close. But at the same time, the president is practical and knows that he doesn't want to upend the economy. So I think the market is trying to manage that balance. And yesterday was a day where they weren't so sure. That's why I think we had a lot of selling. But I think, as time passes, I do think at the end of the day, we expect the White House to find something that is a good balance between the two.
All right. So you're going on the idea, it sounds like, that you think tariffs aren't going to be as bad as the bark would suggest. Is that at the end of the day? Is that right?
That's right. I mean, tariffs are already annualizing $2.4 trillion a year, which, if you now compare it to where the budget is, it's actually neutralizing, the current budget. But it hasn't hurt the wallet and consumer confidence, and it hasn't hurt S&P earnings. So I think at the end of the day that we've had enough time pass that investors can sort of breathe a little bit of a sigh of relief and realize the tariffs, they're important to the White House agenda, but they're not going to necessarily derail the economy.
What if there's too much complacency around that? Got a VIX at 16. You said it's too soon to tell. That's why Chair Powell is waiting to see what happens with inflation. What if we just don't know yet what the real impact on the real economy is going to be? That's true.
That would be a negative fork if that were to happen, and I think the VIX would go up.
Well, isn't that a real possibility? Actually, it's a certainty. Today, we don't know. Do we?
Well, Scott, if we went down that path, then it would also open the door for the legal challenges to come back about what kind of tariffs can be levied without an appropriate process. So I think at the end of the day, look, investors should keep that in mind, but then they should realize we had a black swan develop in April.
April 2nd.
April 2nd, a waterfall decline in stocks. The VIX went to 60, and everyone thought the market wouldn't recover because the Fed wasn't going to unleash liquidity, but it was a V-shaped rebound. So if that should be in people's back of their mind, they shouldn't be too bothered, even if we get a bad chapter in this tariff story.
What's priced in at this point? I keep hearing from people, well, a lot of the good news now, given the rally back and the V-shaped recovery that you said, now all of this good news is priced in. Is it?
I'd say that the ones who are saying it's priced in are a lot of the folks that missed the rally. We speak to a lot of high net worth and hedge funds. Many have missed the bulk of that rally, and they are very skeptical here.
They're mad and they're hating on it now?
Yes, that's why it is the most hated V-shaped rally ever. Worse than 2020 and 2022. But I'd argue that the PEs should be expanding. The median PE, the S&P, is lower than it was on the eve of COVID 2020 by 1.5 turns. Mm-hmm. So the market's cheaper, and we had 6 black swans. We had COVID, we had the supply chain shock, we had the inflation shock, the Fed's fastest hikes in history, we had Trump Armageddon, and then we had the U.S. bombing Iran nuclear facilities. 6 black swans. Mm-hmm. The market produced earnings growth the entire time. If this was a stock, we would say it's sort of indestructible, and we should give it a higher PE, but the market derated.
All right, I'm writing down as you were answering that question. can the multiple expand while earnings and margins are contracting? Can that happen? Because margins are probably contracting a bit, right? I mean, unless you're passing through all these costs to your customers, which I think a lot of companies are reticent to do. Earnings, we know, are contracting because estimates have come down by near half.
Yeah. Now, on the margin side, you have to keep in mind that if, let's say, companies are eating half the tariffs, the gasoline already offsets that. So I'd actually say there's no margin risk from the current level of tariffs.
No margin risk at all from now?
Yeah, I mean, on balance, because there's 500 companies, but I would say it's offsettable because of the way some of the commodities have deflated. So I think earnings growth is actually still intact.
But sure, we are going to have earnings growth. Growth is intact at far slower levels than we were once thinking.
However, we also know that ISM has been below 50 for 29 months, a record period below 50. And that is highly correlated with S&P forward growth. So if we get the tariffs issue settled and the Fed breathes a sigh of relief, starts cutting, and the ISM moves above 50, I think earnings estimates for next year actually go up.